If you've got kiddos at home, you've probably discovered that paying for childcare is no joke. The same can be said of hiring in-home help for a disabled or elderly family member. If you find yourself in that season of life, money can be tight. But there might be some good news for you when it comes to tax season. It's called the Child and Dependent Care Tax Credit, and we've got all the juicy details. Or not so juicy. Because, it's taxes. So what's a tax credit? And is it the same as a tax deduction? Well, a tax credit cuts your tax bill dollar for dollar. The more credits you claim, the less you'll owe the IRS, and you might get money back. Let's say you owe $2,000 in taxes. If you claim a $500 credit, it slashes your bill to $15. Not too shabby. A tax deduction, on the other hand, will reduce your taxable income instead of directly cutting down your tax bill. So a $500 tax deduction would save you $110 if you're in the 22% tax bracket. How does the Child and Dependent Care Credit work? For the 2022 tax year, you can claim this credit when you pay for childcare or dependent care, so you can either work or look for work. That's pretty straightforward. But it gets more complicated, of course, so hang with us. You can claim this credit on dependent care expenses of up to $3,000 for one qualifying dependent and $6,000 if you had two or more qualifying dependents. But you don't get the whole $3,000 or $6,000. You get a percentage of it depending on your income, and it maxes out at 35%. That's a lot of numbers to decode, so let's look at an example. Let's say you have two children under 17 years old living with you year-round. You and your spouse also moved in your mother-in-law 8 months ago and hired a memory care assistant to stay with her so you and your spouse could work full-time. Phew, it's been a busy year full of changes for your household. Take a breath. You paid $5,600 in childcare and $8,400 for the memory care assistant, totaling $14,000 for the year. If you and your spouse file jointly and make over $43,000 combined, the most you could be credited is 20% of that $14,000, which is $2,800. If you make under $43,000 combined, you could be credited up to 35% of the $14,000, which would be $4,900, depending on where your income falls on the sliding scale. The other thing to keep in mind is that this tax credit is non-refundable. In other words, the best you can hope for is a $0 tax bill. You don't get a refund if there's any left over. So if you have a $100 tax bill but you're credited with $500 from the Child and Dependent Care Credit, your tax bill goes down to zero. Nice. But don't expect a $400 check signed by Uncle Sam to grace your mailbox. Work-related expense test. You must have paid for care for your dependent so you and your spouse, if married, could work or look for work. These payments must be made to someone who you and your spouse can't claim as a dependent. In other words, paying your 15-year-old daughter to babysit your toddler every day after school doesn't qualify. Unfortunately, paying your spouse or the parent of your qualifying child doesn't qualify either. But let's say your kid is 19 or older, going to school part-time, and therefore can't be claimed as a dependent. Paying them to babysit your child so you can work would qualify because they are no longer your dependent. Sweet. Qualifying person test. Your child or dependent who received care must meet these qualifications. If they're a child, they were filed as your dependent and under age 13 when the care was provided. If they're your spouse, they were not mentally or physically able to care for themselves and lived with you for more than half the year. If they're another person, they were not mentally or physically able to care for themselves and lived with you for more than half the year and were your dependent or would have been your dependent if they had not received a gross income of $4,400 or more. Earned income test. You and your spouse, if married, must have earned some income during the year. This includes wages, salaries, tips, other taxable employee compensation, net earnings from self-employment, and any disability pay you report as wages. Tax return test. If your filing status is married filing separately, you can't claim the Child and Dependent Care Credit except in some rare cases. But if your filing status is anything else, single, head of household, qualifying surviving spouse, or married filing jointly, you're good to go. Provider identification test. You must give the name, address, and tax ID number of the person or organization that cared for your dependent.